Tom Lee of Fundstrat recently appeared on CNBC and made a bold claim. While many investors are worried that the market may be approaching a major top, Lee believes those fears are overblown. In fact, he says, everyone thinks this is the top, and points out that there's still roughly $7 trillion sitting on the sidelines waiting to be invested. In this video, I'll play you the interview clip uninterrupted, break down exactly what Tom Lee is saying and whether I agree with his outlook, and then I'll share my analysis of 3 high-growth AI stocks to consider buying right now for your portfolio. Let's hear what Tom Lee has to say.
Tom Lee, Tom, good to chat with you. As best as you know or can tell, what happened on Friday and what happened today? Because those days, 48 trading hours apart, are very, very different.
Yeah, Brian, as you know, stocks had done well for some time. So I think there's a lot of people that are worried about the air gap below because so many stocks move so quickly. And then jitters emerged. I'd say 3 jitters emerged last week. The first is, how strong is the AI trade, especially with some of the guidance that came out of Broadcom. The second, of course, is just the realization that Google is going to raise $80 billion plus SpaceX 75, OpenAI maybe 100, Anthropic 75, and then Meta, of course, filed as well. So there's a lot of equity being raised and asking the public to fund that. And the third is, of course, the geopolitical tensions. I think people get generally nervous into a weekend and they're worried about whether there could be something happening in Iran. So I think those are the jitters. And as you know, we get these pullbacks, in our opinion, and we commented over the weekend on this. I think it's a false narrative to think the bull market is in trouble. I think the bull market's still intact and in very good shape.
Tom, it's Kelly here back at the studio. And one of the areas that's been obviously most under pressure is crypto. And I know that you say people shouldn't throw in the towel, but I think it feels like a lot of the kind of buying velocity has simply left the space. And I'm not sure when it will ever return.
Well, yes. I mean, Kelly, I think people are really disappointed by crypto this year because, number one, they didn't go up when AI was going up. But in some ways, crypto is a downstream story of AI because as AI capabilities go up, we already hear it from a lot of those AI researchers, it's going to increase the need for blockchain because that's the only way to prove and validate transactions and actually protect us from AI. Last week, I think that there were some high-profile sort of, quote, AI security exploits, one that happened on the Orchid suite for Zcash. And that caused some panic. I don't know why it should have caused all of crypto to sell off. But keep in mind, AI exploits are happening at a rapid pace and an increasing pace across all of financial services. It's just that the publicly traded banks don't actually reveal the exploits. So I think that these attack surfaces are increasing everywhere, and we have to be mindful of that. And the third is, Wall Street is still tokenizing. It's a big innovation. Turning money into software, tokenizing equities and real estate, these are composability issues that only happen on blockchain. So to me, I think the crypto narrative is still in good shape, but you're right. The excitement and the FOMO has been in AI.
Tom, going back to the stock market, we're seeing some of the Mag 7 stocks down. The Dow is down just a touch. The NASDAQ 100 is still up 2%, but all the averages have come back. We'll likely end the day higher, but if the S&P were to end the day lower after the boom that we had for the first couple of hours today, would in any way that change the way that you look at this market? And if not, what would?
Well, Brian, there is going to be a lot of tension in markets until June 12th, because I'd say there's a very large camp of our institutional investor clients that would say SpaceX is going to be the market top. So they're anticipating the markets to wobble. So what they're going to do is take profits and be cautious onto that date. But I'd say that history shows that the SpaceX IPO should not actually mark the market top. It's actually rare a big IPO marks a top. So to us, I think it's actually misplaced concerns. There's still $7 trillion of cash on the sidelines, And we already know the book's been filled. High net worth clients have a lot of cash available to buy this IPO. So I think the market's going to not only absorb this IPO really well, but I think the market's going to do well post-IPO.
If you only had a fixed amount of money, Tom, would you invest in these IPOs?
These are some of the most important companies led by what they call N of one people. I mean, I don't know if there will be another Elon Musk in our generation. So for investors who have not owned Tesla, this is a chance for them to have exposure to Elon Musk and all of what he's envisioned. And again, the addressable market for AI and especially data center, and as you move into space, is actually sizable.
One of the first things Tom points out is that markets had been running hot for a long period of time. When stocks climb rapidly, especially technology stocks, investors naturally begin worrying about what he calls the air gap below. In other words, when prices rise too far too fast, any negative news can trigger a sharp drop because there is very little support underneath current prices. That does not necessarily mean the fundamentals have changed. It simply means investors become more sensitive to risk. I actually think this is an important distinction that many investors overlook. A stock can fall 10% or even 20% without the long-term investment thesis changing at all. Sometimes what changes is simply sentiment. Markets move not only on earnings and cash flows, but also on emotions. Fear can be just as powerful as greed. Tom identifies three major concerns that shook investor confidence during the week. The first concern revolves around artificial intelligence. Investors began questioning whether the AI trade remains as strong as many people believed. After years of explosive gains in AI-related stocks, expectations have become incredibly high. Any guidance from major companies that appears even slightly less optimistic can trigger anxiety throughout the market. This is something I have been warning about for quite some time. When expectations become too extreme, companies do not need to disappoint investors. They simply need to be less impressive than the market hoped. The higher the expectations, the harder it becomes to exceed them. That creates vulnerability even when the business itself is performing very well. The second concern Tom highlights is the massive wave of capital raising taking place among AI companies and technology giants. He references enormous funding needs from companies such as Google, OpenAI, Anthropic, Meta, and of course SpaceX. The concern here is simple. Investors worry that all of these companies are asking the market for enormous amounts of money at roughly the same time. When hundreds of billions of dollars need to be raised, some investors fear that capital will be pulled away from existing stocks in order to fund these new opportunities. This is a reasonable concern on the surface. However, Tom's argument is that investors are overestimating the impact. He points out that there is still an enormous amount of cash sitting on the sidelines waiting to be deployed. In his view, the market has more than enough liquidity to absorb these capital raises without causing lasting damage. Personally, I think this is one of the most fascinating debates happening right now. On one hand, the AI infrastructure build-out is requiring historic levels of investment. On the other hand, if these investments generate the productivity gains many analysts expect, the returns could justify today's spending. The challenge for investors is determining whether current valuations already reflect those future benefits. The third concern Tom mentions involves geopolitical tensions. Markets never like uncertainty, and investors often become especially nervous heading into weekends when unexpected events can occur while markets are closed. Concerns surrounding global conflicts and tensions in the Middle East added another layer of caution to investor thinking. Again, this is not unusual. Throughout history, geopolitical fears have repeatedly caused temporary market pullbacks. Sometimes those fears develop into larger issues, but often the market eventually refocuses on corporate earnings, economic growth, and liquidity conditions. What stands out most in Tom's comments is his belief that these concerns are being exaggerated relative to the actual risks facing the market. He openly calls the idea that the bull market is ending a false narrative. That is a strong statement, but it reflects his broader view that the primary trend remains positive. The conversation then shifts toward cryptocurrency, which has clearly frustrated many investors this year. While AI stocks captured most of the excitement and attention, many crypto assets failed to participate to the same extent. This has led some investors to question whether the crypto story has lost momentum. Tom takes the opposite view. His argument is that cryptocurrency and blockchain technology may actually become more important as artificial intelligence becomes more powerful. The reasoning is interesting. As AI systems become increasingly capable of generating content, executing transactions, and interacting autonomously, proving authenticity becomes more valuable. blockchain technology can potentially serve as a verification layer that helps validate transactions and establish trust. Whether you fully agree with that argument or not, it is certainly a perspective that deserves consideration. One of the biggest challenges in an AI-driven world will be determining what is real, what is authentic, and what can be trusted. Blockchain technology was designed to address certain trust and verification problems, which is why some analysts see a future connection between the growth of AI and the growth of blockchain adoption. Tom also references recent security incidents within the crypto ecosystem. He argues that investors may have overreacted to isolated events. More importantly, he points out that AI-driven security threats are increasing across the entire financial system, not just crypto. According to his reasoning, vulnerabilities exist everywhere. The difference is that problems within decentralized ecosystems tend to receive much more public attention. I think there is some truth to that observation. Traditional financial institutions experience cyber threats constantly, but many incidents never become major public stories. Crypto markets often operate under a microscope, where every exploit receives immediate attention and scrutiny. Tom then discusses tokenization, which may be one of the most overlooked trends in finance today. The concept involves converting traditional assets such as stocks, real estate, and other financial instruments into digital tokens that can exist on blockchain networks. His view is that tokenization represents a fundamental innovation because it transforms assets into programmable software. If tokenization continues to gain adoption, it could significantly reshape how ownership, settlement, and transfers occur within financial markets. Whether tokenization becomes a trillion-dollar opportunity remains to be seen, but it is certainly attracting serious attention from major financial institutions around the world. The discussion eventually returns to stocks and specifically to the upcoming SpaceX IPO. This is where things become especially interesting because Tom reveals that many institutional investors view the IPO as a potential market top. In other words, some investors believe that once one of the most anticipated public offerings in history arrives, enthusiasm will peak and the broader market will begin to roll over. Tom disagrees. He argues that history does not support the idea that major IPOs consistently mark the top of bull markets. While some investors are positioning defensively ahead of the offering, he believes those concerns are misplaced. His reasoning centers on liquidity. According to Tom, there remains trillions of dollars in cash available for investment. If that cash enters the market, both the IPO itself and the broader stock market could continue performing well after the offering. I find this part of the interview particularly important because it highlights the difference between narratives and data. Market participants often create compelling stories about why something must happen. The problem is that compelling stories are not always supported by historical evidence. Just because an IPO is highly anticipated does not automatically mean it will signal the end of a bull market. Finally, Tom is asked whether investors with limited capital should consider participating in these major IPOs. His answer reveals how highly he views companies like SpaceX. He describes them as some of the most important businesses in the world and emphasizes the unique leadership behind them. Specifically, he points to Elon Musk as a once-in-a-generation entrepreneur whose influence extends across multiple transformative industries. Whether investors agree or disagree with that assessment, there is no denying that many of today's largest investment opportunities are being shaped by a relatively small group of visionary founders. The challenge for investors is determining how much of that future success is already reflected in current valuations. And that is really the central takeaway from this entire interview. Tom Lee is not dismissing the risks. He acknowledges concerns surrounding AI spending, crypto weakness, geopolitical tensions, and the enormous scale of upcoming IPOs. But his message is that investors are allowing those concerns to overshadow what he still sees as a healthy bull market supported by liquidity, innovation, and long-term growth trends. The real question is whether the market's recent fears are temporary obstacles or early warning signs of something bigger. Tom clearly believes they are temporary obstacles. As investors, we each have to decide whether the evidence supports that conclusion. Now let's dive in and talk about 3 high-growth AI stocks that could benefit from one of the biggest technological revolutions in history. Let's start with the first stock on the list, SanDisk, ticker symbol SNDK. When most investors think about artificial intelligence, they immediately focus on processors and computing power. But there is another side of the AI revolution that often gets overlooked. Data. Massive amounts of data. Every AI model must be trained, updated, stored, accessed, and processed continuously. Without storage, AI simply cannot function at scale. And that is exactly where SanDisk comes into the picture. SanDisk specializes in NAND memory technology, which plays a crucial role in solid-state drives used throughout modern data centers. As AI systems become larger and more sophisticated, the amount of data being generated is growing at an extraordinary pace. Every prompt, every model update, every inference request, and every enterprise AI application adds to the demand for storage. This is creating a powerful tailwind for companies that supply the infrastructure needed to manage all that information. What makes SanDisk particularly interesting right now is that the company is operating in an environment where supply remains constrained while demand continues to accelerate. That combination can be incredibly powerful for investors. When demand grows faster than supply, prices often rise, and when prices rise, profitability can improve dramatically. This is one of the reasons Wall Street has become increasingly optimistic about SanDisk's growth outlook. Analysts have projected revenue growth of approximately 332% in one upcoming quarter and roughly 337% in the following quarter. Those are remarkable numbers for a company of this size. Think about that for a moment. Many companies would be thrilled to grow revenue 20% or 30% annually. SanDisk is operating on an entirely different scale at the moment. Of course, investors should always be cautious when they see explosive growth rates because growth eventually slows. The question is whether this growth surge is temporary or whether it represents the early stages of a longer trend. Personally, I think that is the most important question investors should be asking right now. If AI adoption continues expanding over the next 5 to 10 years, the need for storage infrastructure could remain enormous. Every major AI deployment requires not only computing power, but also vast amounts of memory and storage capacity. This is where SanDisk's competitive position becomes attractive. The company is not chasing some speculative future opportunity, it is already participating in a market where demand is visible today. Many investors underestimate how much storage AI actually consumes. Training advanced AI models requires processing enormous datasets. Once those models are deployed, they continue generating and consuming data every single day. The more businesses adopt AI, the more data gets created. The more data gets created, the more storage infrastructure becomes necessary, and that creates a potentially durable demand cycle. Another factor that makes SanDisk interesting is valuation. Even though the stock has experienced significant appreciation, many analysts still believe the company deserves a premium multiple because of its projected growth profile. SanDisk has been trading around 28 times forward earnings, reflecting investor expectations that strong growth could continue. Now, some investors may hear that valuation and immediately conclude the stock is expensive, but valuation always needs context. A company growing revenue at low single digits and trading at 28 times earnings would raise concerns. A company growing revenue several 100% while benefiting from structural industry demand is a different story entirely. That does not mean the stock cannot decline. It certainly can. Every stock experiences volatility. However, long-term investors often focus less on short-term price fluctuations and more on whether the underlying business continues strengthening. And right now, the broader AI infrastructure build-out appears to be supporting exactly that. There is another important point worth discussing. Many investors assume that increased manufacturing capacity will eventually solve memory shortages and eliminate pricing power. While additional capacity is certainly being built across the industry, demand is also expanding rapidly. Major AI operators continue investing heavily in data centers. AI applications continue becoming more complex. Model sizes continue growing. Enterprise adoption continues increasing. As a result, new supply may not necessarily eliminate shortages as quickly as some investors expect. In fact, industry observers continue pointing to strong demand across AI-related memory and storage markets. That creates an interesting setup. If demand growth remains strong enough, SanDisk could continue benefiting from favorable industry conditions for longer than many investors currently anticipate. What I find especially compelling is that SanDisk is not dependent on a single product cycle or one customer relationship. Its investment thesis is tied to something much larger, the exponential growth of data. Whether AI becomes twice as large, 5 times as large, or 10 times as large over the next decade, one thing seems clear. The amount of information that must be stored and managed is likely to increase substantially. That trend alone creates a powerful long-term tailwind. Now, that does not mean SanDisk is risk-free. No stock is. Technology cycles can change, competition can intensify, pricing can fluctuate, economic slowdowns can impact spending. and investor expectations can sometimes get ahead of reality. These are all legitimate risks investors should carefully consider before buying any stock. However, when I look at the broader AI landscape, I believe many investors are still underestimating the importance of storage infrastructure. Everyone talks about AI models, everyone talks about AI chips, but without memory and storage, none of those systems can operate effectively. That reality places SanDisk in a very interesting position within the AI ecosystem. It may not always generate the headlines, it may not dominate conversations on financial television, but it provides technology that remains essential to the growth of artificial intelligence. And sometimes the best investment opportunities come from the companies quietly supplying the picks and shovels during a technological gold rush. For investors seeking exposure to AI infrastructure beyond the obvious names, SanDisk is certainly a stock worth putting on the watch list. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second stock on the list is Micron, ticker symbol MU. If SanDisk represents one side of the AI data explosion, Micron represents another critical piece of the puzzle. Memory, and not just any memory. The type of high-performance memory that advanced AI systems increasingly depend on. One of the biggest misconceptions investors make when analyzing the AI boom is assuming that powerful AI models are driven entirely by computing chips. While computing power is incredibly important, those processors cannot operate efficiently without fast access to enormous amounts of data. That is where memory comes in. As AI models become larger and more sophisticated, they require greater amounts of high-bandwidth memory to process information quickly and efficiently. The more advanced the AI system becomes, the greater the demand for memory solutions capable of keeping up with those workloads. This trend has created one of the most attractive growth opportunities in the entire semiconductor industry, and Micron sits directly in the middle of it. What makes Micron particularly interesting is that the company is not simply benefiting from a temporary surge in demand. Instead, it appears to be benefiting from a structural shift in how computing resources are being used across the global economy. Artificial intelligence is changing the requirements for modern computing. Data centers need more memory. AI servers need more memory. Enterprise applications need more memory. Cloud infrastructure needs more memory. Virtually every layer of the AI ecosystem is becoming increasingly memory-intensive. That creates a massive opportunity for companies capable of supplying the products needed to support this transition. One of the reasons investors have become increasingly bullish on Micron is the company's leadership position in high-bandwidth memory, often referred to as HBM. High-bandwidth memory has become one of the most important technologies in modern AI systems because it enables processors to access and move data at extremely high speeds. In simple terms, it helps AI systems work faster, and in the AI world, speed matters. Companies building advanced AI infrastructure are willing to spend significant amounts of money to improve performance, because even small gains can have a major impact at scale. This creates a favorable environment for companies supplying critical components. Micron's management has repeatedly emphasized the strong demand they are seeing from customers building AI infrastructure. The company has benefited from an industry environment where demand continues to outpace expectations. What I find particularly compelling is that Micron is not just participating in AI growth, it is helping enable it. There is an important difference. Some companies are trying to figure out how AI might help their business someday. Micron is already supplying products that AI systems need right now. That makes the investment thesis much easier to understand. The company does not need AI adoption to happen. AI adoption is already happening, and every major AI deployment increases demand for advanced memory solutions. Another reason investors have become excited about Micron is the company's financial outlook. Analysts have projected strong earnings growth as AI-related demand continues driving higher sales volumes and improved profitability. Revenue growth has accelerated significantly compared to previous years, reflecting the increasing importance of memory within modern AI infrastructure. For long-term investors, this matters because earnings growth ultimately drives shareholder returns. A stock price can rise on excitement for a while, but sustainable long-term gains are usually supported by growing profits, and Micron appears well-positioned to benefit if AI spending remains elevated over the coming years. Of course, no investment opportunity comes without risks. The memory industry has historically been cyclical. Prices can rise dramatically during periods of strong demand and fall sharply when supply catches up. This is something investors should never ignore. Semiconductor markets are not always smooth. they can experience periods of volatility that test even the most patient investors. However, there is a growing argument that AI may be creating a stronger and more durable demand cycle than previous technology trends. Historically, memory demand was often driven by smartphones, personal computers, and consumer electronics. Today, AI data centers have become one of the most important growth drivers. And unlike consumer devices, AI infrastructure investments often involve enormous capital commitments that extend over multiple years. That distinction could have significant implications for future demand. Personally, I believe this is one of the most important aspects of the Micron story. Many investors continue evaluating the company through the lens of past memory cycles. But if AI fundamentally changes the scale of memory consumption, future industry dynamics may look very different from the past. That does not guarantee success. But it does suggest investors should be careful about relying too heavily on historical assumptions. Another factor worth considering is the sheer scale of global AI investment. Governments, cloud providers, enterprises, and technology companies are collectively spending hundreds of billions of dollars building AI infrastructure. Those investments require servers, those servers require memory, and that memory demand flows directly into companies like Micron. This creates a situation where the company may continue benefiting from one of the most powerful investment themes of the decade. When I evaluate high-growth stocks, I often ask a simple question. Does this company provide something customers want? Or does it provide something customers absolutely need? In Micron's case, advanced memory increasingly falls into the second category. Modern AI systems simply cannot function efficiently without it. That gives the company an important strategic advantage. The more successful AI becomes, the more valuable that position may become. And that is why Micron continues attracting attention from growth-oriented investors looking for exposure to the AI revolution. While some AI stocks trade primarily on future expectations, Micron is already generating meaningful revenue from AI-related demand today. That combination of current execution and future growth potential makes the company one of the more interesting opportunities in the sector. For investors looking beyond headlines and focusing on the underlying infrastructure powering artificial intelligence, Micron remains a stock worth watching closely. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move on to the third and final stock on the list, CoreWeave, ticker symbol CRWV. This is easily the most aggressive growth story of the three companies we've discussed today, and it may also be the one with the highest risk. But sometimes the biggest opportunities emerge from companies that are helping build the future before the rest of the market fully appreciates what they're becoming. To understand why CoreWeave has attracted so much attention from investors, you first have to understand a major challenge facing the AI industry. Building advanced AI models requires an enormous amount of computing power, not millions of dollars worth, not billions of dollars worth, in many cases tens of billions of dollars worth. The problem is that many companies want access to AI infrastructure but do not want to spend massive amounts of money building their own data centers. They need another solution. That is where CoreWeave comes in. CoreWeave provides cloud infrastructure specifically designed for artificial intelligence workloads. Instead of building and maintaining expensive computing infrastructure themselves, customers can access CoreWeave's platform and utilize the resources they need. In many ways, the company is positioning itself as a critical service provider for the AI economy, and right now, demand appears to be exploding. One of the most remarkable aspects of the CoreWeave story is the pace at which revenue has been growing. The company has experienced extraordinary expansion as organizations rush to secure AI computing capacity. This is not surprising when you consider what is happening across the broader industry. Every major business seems to be exploring AI. Every enterprise wants AI capabilities. Every software company wants AI features. Every startup wants AI integration. All of that activity requires computing infrastructure. And infrastructure providers often benefit significantly during technological transformations. History provides plenty of examples. When a new technology emerges, the companies supplying the underlying infrastructure frequently become some of the biggest winners. That is one reason investors have become increasingly interested in CoreWeave. The company is not competing for a small niche opportunity. It is participating in one of the fastest growing markets in the world. What makes the story even more interesting is the company's backlog. CoreWeave has secured billions of dollars in contracted revenue commitments, giving investors visibility into future business activity. That matters because one of the biggest concerns with high-growth companies is sustainability. Can the growth continue? Will customers stick around? Is demand real? Large contracted commitments help answer some of those questions. They provide evidence that customers are making serious long-term investments in AI infrastructure, and that creates a level of confidence that many younger growth companies struggle to achieve. Now, I want to be clear about something. CoreWeave is not a conservative investment. This is not the type of stock most people would classify as a low-risk opportunity. The company operates in a rapidly evolving industry. Competition remains intense, capital requirements are substantial, and investor expectations are extremely high. Those risks should not be ignored, in fact they should be studied carefully. But high-growth investing often involves balancing risk against potential reward, and the reward side of the equation is what makes CoreWeave so intriguing. If AI adoption continues accelerating over the next decade, demand for specialized cloud infrastructure could grow dramatically. Every new AI application requires computing resources. Every AI model requires training. Every deployment requires ongoing processing power. And all of that activity increases demand for infrastructure providers. One thing I find particularly interesting about CoreWeave is how directly its business is connected to AI adoption. Some companies are trying to integrate AI into existing products. Others are hoping AI improves operational efficiency. CoreWeave benefits from the simple fact that AI workloads require infrastructure. The connection between AI growth and business demand is relatively straightforward. More AI activity typically means more infrastructure demand. That simplicity can sometimes be attractive from an investment perspective. Investors do not have to make multiple assumptions about future monetization strategies. The company provides infrastructure. The market needs infrastructure. The question becomes whether management can continue executing effectively as demand scales. Another reason CoreWeave deserves attention is the enormous amount of investment flowing into artificial intelligence globally. Companies are spending aggressively because they view AI as a transformational technology. Many executives believe AI will fundamentally reshape productivity, software development, healthcare, finance, manufacturing, education, and countless other industries. Whether those predictions prove fully accurate remains to be seen. But one thing seems increasingly clear. Organizations are investing as though AI will become one of the defining technologies of this generation. And whenever that kind of investment wave occurs, infrastructure providers often become major beneficiaries. Think about it from a practical standpoint. Before businesses can use AI, someone has to provide the computing power. Someone has to host the infrastructure. Someone has to manage the resources. Someone has to make large-scale deployment possible. That role creates a potentially valuable position within the broader ecosystem. Now, could CoreWeave experience volatility? Absolutely. In fact, investors should probably expect it. High-growth stocks rarely move in a straight line. Valuations fluctuate, market sentiment changes, growth rates eventually normalize, and competition never stands still. But volatility and opportunity often travel together. That is why investors need to focus on business fundamentals rather than daily stock price movements. The key question is whether the company is strengthening its competitive position as the AI market expands. If the answer remains yes, then temporary volatility may matter far less than long-term execution. When I look across the three stocks we've discussed today, I see three very different ways to invest in artificial intelligence. SanDisk gives investors exposure to the storage infrastructure supporting massive data growth. Micron provides exposure to the memory technologies that help power advanced AI systems. And CoreWeave offers exposure to the cloud infrastructure that allows AI workloads to operate at scale. Each company occupies a different layer of the AI ecosystem. Each company faces different opportunities, and each company carries different risks. Personally, I think that diversity is what makes this list interesting. Rather than betting on a single outcome, investors gain exposure to multiple parts of the AI value chain. If AI adoption continues growing over the next decade, each of these businesses could benefit in different ways. Of course, no investment thesis is guaranteed to work. Markets are unpredictable, competition evolves, technology changes, and even great businesses can experience setbacks. That is why research remains so important. Understanding what a company does, how it generates revenue, and why customers value its products can make all the difference when building a long-term portfolio. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Which of these 3 AI stocks do you believe has the strongest long-term competitive advantage? SanDisk, Micron, or CoreWeave? And which one would you be most comfortable holding for the next 10 years? Let me know in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.